Hey everyone, welcome back to the channel. Today we're diving deep into a huge topic in the crypto world. Something that's been on everyone's mind since the start of this year. Bitcoin ETFs versus holding your own Bitcoin. It's the classic battle of convenience versus control, and the right answer for you really depends on what you value most. So let's break it down, look at the pros and cons of each, and help you figure out which path is the best fit for your investment strategy. First up, let's talk about the shiny new thing on Wall Street. Spot Bitcoin ETFs. What exactly are they? Think of an ETF or exchange-traded fund as a basket of assets that trades on a stock exchange, just like a regular stock. A Bitcoin ETF, then, is a fund that holds actual Bitcoin. When you buy a share of this ETF, you're buying a claim on a small piece of the Bitcoin held by the fund. The biggest, most obvious advantage here is simplicity. If you already have a brokerage account for stocks, like a Fidelity or Charles Schwab account, you can buy a Bitcoin ETF with just a few clicks. There's no need to sign up for a crypto exchange, figure out how wallets work, or worry about seed phrases. It's as easy as buying a share of Apple or Tesla. This familiarity and ease of access have opened the doors for a massive wave of new investors who were maybe a little intimidated by the technical side of crypto. Another huge plus is regulation and security from a traditional finance perspective. These ETFs are offered by major, well-established financial institutions like BlackRock and Fidelity. They're regulated products, trading on regulated exchanges. This brings a level of trust and institutional-grade security that many people find comforting. The Bitcoin held by these funds is stored with professional custodians who use incredibly sophisticated security measures to protect the assets. For many, this feels a lot safer than being solely responsible for their own digital keys. Plus, you can hold these ETFs in tax-advantaged accounts like an IRA or a 401k, which is a massive benefit for long-term retirement planning. This is something you simply can't do with Bitcoin. You hold yourself. So, to recap the pros of ETFs. Super easy to buy and sell, regulated, backed by big names, and they can fit into your traditional retirement accounts. Sounds pretty great, right? But, of course, there are trade-offs. The single biggest one is summed up by a famous saying in the crypto community: not your keys, not your coins. When you buy a Bitcoin ETF, you don't actually own any Bitcoin directly. You own a share of a fund that owns Bitcoin. You can't send that Bitcoin to a friend, you can't use it to buy something online, and you can't move it to your own personal wallet. You have exposure to the price of Bitcoin, but you don't have control over the underlying asset. This is a fundamental point for many Bitcoin believers. The whole idea behind Bitcoin was to create a decentralized financial system where you are your own bank. With an ETF, you're reintroducing a third party, a custodian, and a financial institution right back into the middle. You're trusting them to hold your assets securely and to always honor your claim. While the risk of a major firm like BlackRock losing your assets is extremely low, it's not zero. We've seen collapses in traditional finance before. Then there are the fees. ETFs come with an expense ratio, which is a small percentage of your investment that you pay every year to the fund manager. These fees might seem small, often less than 0.5%, but over many years they can eat into your returns. Holding your own Bitcoin once you've bought it has no ongoing management fees. So let's switch gears and talk about self-custody. This is the OG way of holding Bitcoin. It means you are in complete control. You hold the private keys to your Bitcoin in a wallet that only you can access. These wallets can be software wallets on your phone or computer, or for the highest level of security, hardware wallets, which are small physical devices that keep your keys offline. The number one advantage of self-custody is sovereignty. It's your money, period. No one can freeze your account, no one can stop you from sending it, and no one can take it from you without your private keys. You are your own bank. This is the core principle of Bitcoin, and for many, it's non-negotiable. It gives you the freedom to use your Bitcoin as it was intended as a peer-to-peer electronic cash system. You can participate in the broader crypto ecosystem, use decentralized finance applications, or simply have the peace of mind that your wealth is under your direct control. There are also no management fees. You might pay a small transaction fee when you send Bitcoin on the network, but there's no yearly percentage skimmed off the top of your holdings. Over the long run, this can make a significant difference in your total returns. Now, for the flip side. With great power comes great responsibility. The biggest drawback of self-custody is that you are 100% responsible for your own security. If you lose your private keys or your seed phrase, that list of 12 or 24 words that can restore your wallet share, Bitcoin is gone forever. There's no customer support to call, no forgot my password link to click. It's a harsh reality, and it's a level of personal responsibility that can be daunting for many people. You also have to protect yourself from scams and hacks. Phishing attacks, malware, and other social engineering tricks are common. You need to be educated, vigilant, and practice good security hygiene, like using a hardware wallet and never, ever sharing your seed phrase with anyone or typing it into a website. This learning curve and the constant need for vigilance are the main reasons why some people prefer the simplicity of an ETF. So, how do you choose? There's no single right answer, and it really comes down to a personal assessment of your goals, your technical comfort level, and your philosophy on what Bitcoin represents. Let's run through a few scenarios. If you're a long-term investor, primarily interested in Bitcoin as a store of value, and you want to include it in your retirement portfolio alongside stocks and bonds, an ETF is an excellent, straightforward option. It gives you the price exposure you want without the technical headaches of self-custody. You trust the traditional financial system and are comfortable with the not your keys, not your coins trade-off for the convenience and integration it offers. On the other hand, if you believe in the core mission of Bitcoin financial sovereignty, decentralization, and censorship resistance, then self-custody is the only way to go. If you want to actually use your Bitcoin, or if you're fundamentally skeptical of traditional financial institutions and want to eliminate third-party risk, you need to hold your own keys. You are willing to take on the personal responsibility of securing your assets in exchange for complete control and freedom. But here's a thought: it doesn't have to be an all-or-nothing decision. A hybrid approach can be a fantastic strategy. You could put a portion of your Bitcoin allocation into an ETF within your tax-advantaged retirement account for easy, long-term growth. At the same time, you could buy a smaller amount of Bitcoin on an exchange and move it to your own hardware wallet. This approach gives you the best of both worlds. You get the benefits of the traditional financial system for a part of your holdings, and you also get to experience true ownership and learn the ropes of self-custody with a manageable amount. You can dip your toes into being your own without putting your entire investment at risk while you're still learning. This also diversifies your custodial riskier, not putting all your eggs in one basket. Whether that basket is a brokerage firm or your own security setup. Ultimately, the launch of Bitcoin ETFs is a massive step forward for the asset class. It brings legitimacy, new liquidity, and makes it accessible to millions. But it's important to remember what it is and what it isn't. It's a financial product that tracks the price of Bitcoin. It's not a replacement for Bitcoin itself. The key takeaway is to educate yourself, understand the mechanics of both options. If you're considering self-custody, take the time to learn about hardware wallets, seed phrases, and security best practices. Start small. If you're leaning towards an ETF, read the prospectus, understand the fees, and know who the custodian is. The choice between a Bitcoin ETF and self-custody is a choice between convenience and control. One isn't inherently better than the other. They just serve different purposes for different people. By understanding the trade-offs, you can make an informed decision that aligns with your personal financial goals and your vision for the future of money. Thanks so much for watching today. I hope this breakdown was helpful. Which path are you choosing, or are you going for a hybrid approach? Let me know down in the comments. And if you got value from this video, please hit that like button and subscribe for more content. See you in the next one.